Introduction. Good morning, everyone. Today, we're delving into the world of accounting standards with a focus on IAS-2, the International Accounting Standard governing inventories. This standard offers clear guidance on determining inventory costs, recognizing expenses, and managing write-downs to net realizable value. So, let's explore these concepts together and illustrate them with real-world scenarios. Definition and scope. First off, let's define inventories according to IAS-2. They're essentially assets held for sale in the regular course of business, in various stages of production, or as materials and supplies destined for use in production or service delivery. Consider this. In a retail giant like Walmart, inventories encompass everything from electronics to groceries lining the shelves. On the other hand, for a manufacturing powerhouse like Toyota, inventories span raw materials, work-in-progress items, and finished products awaiting sale. Measurement of inventories. Now, onto the nitty-gritty of inventory valuation. IAS-2 dictates that inventories should be measured at the lower of cost and net realizable value. Let me break it down with an example. Imagine a clothing retailer purchasing a batch of t-shirts. The cost would comprise not just the purchase price, but also additional expenses like shipping and handling. However, if some t-shirts suffer damage and can only fetch a reduced price, say due to stains or defects, their net realizable value drops accordingly. Cost of inventories. Moving on to the components of inventory cost. It includes purchase costs, conversion costs, and any other expenses incurred in getting those goods to their current state and location. For instance, purchase costs encompass not just the price tag but also import duties and transportation fees. Similarly, conversion costs cover direct labor and a fair share of fixed and variable overheads. Plus, don't forget those additional costs necessary to tailor products to specific customer requirements. Cost formulas. IAS-2 offers flexibility in determining inventory costs through various formulas like specific identification, FIFO, and weighted average. Let's illustrate this with a scenario. Suppose a company procures units at different prices and later sells a portion. Under FIFO, the cost of goods sold is calculated based on the oldest units first. Conversely, the weighted average method spreads costs evenly across all units sold. Net realizable value, NRV. Next up, net realizable value, or NRV for short. It's essentially the estimated selling price minus the estimated costs of completion and sale. Picture this in a retail setting where market conditions may alter the value of goods. For example, a product originally priced at $50 may now fetch $55 due to demand. However, after factoring in selling expenses like marketing and delivery, the net realizable value might be adjusted downward. Write-downs and reversals. In instances where inventory costs exceed NRV, write-downs are necessary. Yet, if circumstances change or there's evidence of an NRV increase, these write-downs can be reversed. Let's consider a seasonal goods scenario to illustrate. Say a retailer marks down winter coats post-season. However, if an unexpected surge in demand occurs, prompting higher selling prices in spring, the initial write-down can be reversed, restoring the original cost value. Recognition as expense. Lastly, when inventories are sold, their carrying amount becomes an expense, aligning with the period when revenue is recognized. Take a sales transaction, for instance. If a retailer sells products initially costing $10 each for $15 each, the cost of goods sold equals the original cost multiplied by the units sold, while revenue reflects the selling price multiplied by the same units. Conclusion. In conclusion, IAS-2 serves as a beacon guiding us through inventory valuation and cost recognition. Its principles ensure consistency and reliability in financial reporting, laying a solid foundation for transparent financial statements. Thank you for your attention, and I'm here to address any queries you may have.